Well, g'day there, traders and friends, market participants and enthusiasts right around the world. Thanks for joining me on YouTube as I sit down and bring you a very quick outlook for two selected individual stocks, which I'm keeping a very close eye on as we transition into the full week of trading upcoming. I'm expecting a major move to occur in at least one of these stocks, maybe even potentially both, and I'm going to very quickly go through some of the reasons as to why I'm so interested in these next couple of stocks. So the first stock which I want to speak to you about is Disney. Now, Disney, this is, I guess, the chart of Disney. There aren't any lines on it, so what I'll do first of all is just right-click and bring back some support and resistance lines and also two particular trend lines which have got me somewhat excited about this particular stock. Now, as you can see on Disney, it is rather neutral. Depending on which way you look at it, you could say, well, we are somewhat moving sideways in some form of a big consolidational pattern. You can see that we have had some oscillations back up into resistance, then very quick sell-offs down into support, an aggressive rally up to the top in November, back down to support. But since this date over here, February 2016, it's looking as though we have more so transitioned or at least moved into some form of a symmetrical triangle. Now, generally, symmetrical triangles, they take the form of anywhere between 1 to 3 months. You can stretch it out to maybe even as far as 6 months. So, I mean, this potential sort of symmetrical triangle that I'm looking at right now, it really is stretching the analysis. However, I do like it. The reason why is because the price of Disney, at least, is observant to trend line. So as you can see, we've got the first bearish trend line up the top. We've got a couple of touches since then. Now, on the downside, or at the support level as well, we've got that first oscillation up back into that first level of, I guess, the primary bearish trend, which makes up the symmetrical triangle. We've got the sell-off back down, which is established once again that higher low. So we've got a series of consecutive lower highs, which is making this top line up here, and then a series of higher lows, which is really giving us that support line. But what is most important right now is that Walt Disney is more or less in the apex of it. It looks as though we're starting to break down to the downside out of this symmetrical triangle. We haven't really seen volume really cement or confirm the move. We haven't really seen any major momentum from the outbreak of this apex, but we've got a couple of contingent orders, one of which is what I'm paying attention to on the downside, around 94.42. If that triggers, and if this turns out to be a legitimate, sustainable sort of breakdown of the chart pattern, well, at a bare minimum, you're looking at a move down to 88.80. But really what you do, and this is where, I spoke to people over the weekend, is that you take the first oscillation here, we call this a measured move, and then we will extend it from the breakout. And I believe that this comes to a figure around $30. If we take that figure from about 96, we're looking at a price level on Walt Disney at about $66. Now, I'm not sitting here to say, hey, my target on the downside is $66. That's just simply not right. But it is a very interesting type of price level if in fact this pattern does play out. Also over the weekend, I was speaking about the symmetrical triangle and what happens if we hold at this support area, and say for instance on Monday, even Tuesday, Wednesday, we start to see a bounce. We see some nice healthy bullish candlesticks and we start to see a really aggressive move to the upside. Well, then what we will say is that, look, this may have been a false little breakdown, a short-lived breakdown, really, which has just tested a lot of shorts, probably trapped a lot of shorts, and that we're going to see again that rally. Now, I'm looking for a big rally if in fact that does occur, or at least a big move in one of the two directions. The level which I'm paying attention to, however, on the upside is up here just under $99 a share. It is above this downward sloping resistance area, which makes up, I guess, the pattern structure. And also I want to see it get above some of this congestion before I start to buy calls in Disney. So keep an eye on it anyway. I thought it was worthy to bring to your attention, but a very nice pattern. Again, it is stretching it in terms of, I guess, the textbook type of pattern that we look for in symmetrical triangles. Generally, they are resting patterns within a trend. Now, obviously, Walt Disney hasn't really been in a trend. Again, it's been moving sideways since about 2014. We did peak over here, and that was going back towards the middle of 2015. Before the markets got into their sideways state. But as the markets again have broken out to relative new time or all-time highs, simply Disney is not up around 120. In fact, it's down at $95 a share. So it's either lagging the overall markets, or it is, alerting us to potential further or future weakness, which may flow into Disney moving forward and sort of rounding out 2016. Now, that second share that I wanted to speak to you about. So first of all, Walt Disney is what we call a neutral share. We really don't have an overwhelming sort of consensus, one direction or another. Now, a little bit different for Target. Target is relatively bearish right now, and I'm going to walk you through why that is. We have been, again, a lot of shares. This isn't only specific to the two that I've outlined in this particular video, but a lot of shares have been in sideways consolidational patterns, if not all-out bearish trends, and that is really across the board. Now, Target is still within this consolidational pattern. It is within some form of a really ugly type of channel. We've got varying areas of support and resistance within the channel, but what's most important is the recent price action. Now, let me just walk you through some of this information. Now, going back towards March, April, May, as the markets were relatively bullish, we developed a double top on Target right up at this resistance area. We broke the neckline on good volume and, again, aided and helped buy earnings. We got a gap down. We gapped all the way down to support at about $67 a share. Now, we've had some Fibonacci retracement levels based off this cycle wave from resistance down to support, and we've got a red box around here. Also, if I bring up the long-term simple moving averages, you can see the 100 and the 200 also confirm this red box. And the red box, if you ever see any of these on my charts, it means resistance. Now, what we've done is we've come up, we've pushed up into the red box. We've got what we call a shooting star candle. We have a 3-day evening star reversal candle, a really nice engulfing type of pattern. We've got consecutive dojis over and over again. We've got multiple gaps. Our first trigger was 71.58. We have a secondary trigger here at 69.12, and this is for the bearish continuation off from this resistance box. Now, we flirted with this a couple of times. We went back up to the top of the box. Now we're starting to really break down below the box and confirm again the continuation of this most recent selling wave, which is going to take us down to about $66 at a minimum. So what we're looking at right now appears to be a bear flag. So we're reversing, and let me just bring up these exponential moving averages. We have sort of bounced back up into these declining exponential moving average. We have a really nice alignment of the 10, the 20, and the 50. And I mean, the candlesticks haven't at this point confirmed the continuation, but I am expecting to see, again, prices push lower in Target. What makes this trade interesting is that the markets themselves, once again, are extremely overbought. They're overextended. They're developing types of, or at least chart patterns, which we look at and say, hey, that's a double top. And again, they haven't confirmed. We're still holding above that 50 exponential moving average, or at least we haven't seen a material breakdown and hold across the 3 US equity markets. But if in fact that does occur, well, that is going to contribute to the weakness that we are already seeing in the Target picture. So the way you need to, I guess, look at Target at the moment is that you have to be relatively bearish on the stock until it comes down to macro support down here, about $66 up to $67 a share. The reason why this is so important is that this is on the weekly chart, so I've changed out from the daily to the weekly, is that around this area, let me just go in another fractal for you. I'm zooming in, trying to get this data, is that, again, once we develop a macro resistance like we did at the beginning, or sorry, midway through 2013, it will act as support once we break above it. So we broke above it in late 2014. We have oscillated back down to support once. We've held it twice, all right? So we've had 2 bounces since that 2013 establishment of that resistance area. It has held as resistance on 2 occasions in 2016, and it looks as though for the 3rd time post that 2013 establishment of that resistance area that we are going to see once again another back test. And, you know, another opportunity, at least for the bulls on Target, to hold this critical area around $66. We call this a pivot point. So short-term bearish on Target, and then we ask ourselves the question, what do we do once and if the price of Target comes down to $67 a share? And the answer to that question is more or less is that we set up neutral trades. So what we'll do is we'll set up bidirectional trades. We will look for bullish opportunity if it bounces off from support. And we will also look for bearish opportunity if it starts to break down below support and if it starts taking out a lot of these lower wicks, which have developed in 2016. I don't expect that to happen unless the market right now has put in a whipsaw and an all-time top, all right? And again, it's too early to say that on these markets, so I'm expecting Target, as at the current juncture, to ultimately make its way down to about 67, and that will most likely sort of coincide with another buying opportunity, which is going to fit, I guess, the narrative and the thesis of some form of a channel consolidation, and that will just be the next oscillation back up to resistance. So I hope that's helped. It's something that I'm looking out for, and a little bit of trading opportunity, upcoming, maybe not this week, potentially on Disney, if in fact we see a major move or the beginning of a major trending type of move in Disney. But target's sort of a, you can, as per your own analysis, of course, is that look, you can look for an aggressive entry at a trigger which you feel comfortable with, but more so the opportunity which is going to sort of establish itself once we hit the support down here at $67 a share. So I'm excited about that. I'm interested in that, and I am keeping a very close eye on these two particular stocks outside of our Pro Top 12 individual trade list. But right now, regardless of that, have a fantastic conclusion to your weekend. It's most likely Sunday evening, where you are in the world. And I look forward to bringing you some more information throughout the week if in fact we see a material breakdown, or I guess continuation to the upside across the market. It has been a relatively range-bound type of sort of stagnant, sideways moving market for a number of weeks now, but we are again drilling into or at least some interesting chart patterns which are most certainly setting up, but are still yet to confirm. So keep a very close eye on that. Until then, enjoy the remainder of your weekend, and I'll see you soon enough. All the best, everyone. It is James signing off on behalf of Pivot Point Trading. Goodbye.